Central banks, institutions like the Federal Reserve in the United States, the European Central Bank, or the People's Bank of China, wield immense, often unseen, power over global economies. They operate with a stated purpose: to stabilize financial systems and foster economic growth. This mission is presented as a public good, essential for prosperity. However, a closer examination reveals a different reality. Their policies frequently distort markets, create artificial booms and busts, and concentrate wealth. These actions often enrich a select few, while trapping nations and their citizens in cycles of debt and diminishing purchasing power. The core argument is clear. The actions of central banks, despite their benevolent facade, primarily benefit a narrow elite. This comes at the direct expense of the broader population, who bear the hidden costs of these interventions. Understanding these mechanisms is crucial for anyone seeking financial autonomy. One of the most potent tools in the central bank arsenal is money printing, commonly known as quantitative easing, or QE. This mechanism involves central banks creating new money digitally to purchase vast quantities of financial assets. These assets typically include government bonds, mortgage-backed securities, and at times even corporate debt. The immediate impact of QE is to flood the banking system with cheap cash. This influx of liquidity is intended to stimulate lending and investment. However, it often results in a significant inflation of asset prices, particularly in the stock market and real estate sectors. The primary beneficiaries of this policy are Wall Street institutions, large commercial banks, and the ultra-wealthy who own the majority of these inflated assets. Their portfolios swell in value, creating a significant wealth effect for those at the top. Conversely, average citizens find their wages failing to keep pace with the rising cost of living. Their hard-earned savings also lose value as the currency supply expands. Central banks actively manipulate interest rates, using them as a lever to influence economic activity. When they seek to stimulate the economy, they artificially lower interest rates, making borrowing incredibly cheap. This encourages corporations and individuals to take on more debt, theoretically boosting investment and consumption. Conversely, when inflation becomes a concern, central banks suddenly raise interest rates. While presented as a necessary measure to fight inflation, these sharp increases often trigger market crashes and economic slowdowns. The timing and magnitude of these shifts can be highly disruptive. The beneficiaries of persistently low interest rates are typically large corporations. They can borrow cheaply to fund expansion, engage in stock buybacks, and consolidate market power. Governments also benefit, as they can finance endless borrowing at minimal cost, expanding national debt without immediate consequence. The detriment falls heavily on small businesses, which struggle to compete with the cheap capital available to larger entities. Home buyers and workers face the burden of increasingly unaffordable loans and mortgages when rates rise. This creates a two-tiered system where access to capital is skewed. Excessive money printing, a direct consequence of policies like quantitative easing, inevitably leads to currency devaluation. As more money enters circulation without a corresponding increase in productive output, the purchasing power of each unit of currency diminishes. This process is commonly known as inflation. The effect of this devaluation is felt directly in the real costs of living. Housing, food, energy, and other essential goods and services see their prices rise significantly. These increases often far outstrip the officially stated inflation targets, which are frequently based on narrow baskets of goods. The primary beneficiaries of currency devaluation are large debtors, particularly governments and corporations. They are able to repay their outstanding loans with currency that is worth less than when it was borrowed. This effectively reduces the real burden of their debt. However, the detriment is borne by workers and savers. Their wages do not keep pace with rising prices, leading to a decline in real income. The value of their savings erodes, effectively confiscating their wealth through a hidden tax. A recurring pattern in central bank policy is the provision of massive bailouts for failing financial institutions. When major banks or corporations face collapse due to reckless behavior, central banks often step in, printing vast sums of money to rescue them. This prevents systemic collapse but socializes the losses. In stark contrast, the public is frequently subjected to austerity measures. Governments, often under pressure from international bodies influenced by central bank policies, implement cuts to essential public services. Pensions, healthcare, education, and social safety nets are reduced or eliminated. The beneficiaries of these bailouts are unequivocally the too-big-to-fail banks, such as J.P. Morgan Chase, Goldman Sachs, and other financial giants. Their executives and shareholders are shielded from the consequences of their risky decisions. They are deemed essential to the system, regardless of their actions. The detriment falls squarely on taxpayers and the general public. They are forced to bear the financial burden of Wall Street's reckless bets, either through direct taxation or through the hidden tax of inflation. This creates a moral hazard, encouraging further risk-taking by those who know they will be rescued. Financial repression is a subtle yet powerful mechanism employed by central banks to manage government debt. It involves suppressing interest rates to levels below the rate of inflation. This makes traditional savings accounts and low-risk investments effectively worthless in real terms. The effect of this policy is to force individuals out of safe, low-yield assets. Savers, desperate to preserve their capital, are pushed into riskier investments like stocks and real estate. This influx of capital into these markets often contributes to the formation of asset bubbles, creating artificial wealth. The primary beneficiaries of financial repression are asset owners, who are typically the wealthy. Their existing portfolios of stocks and real estate appreciate, further widening the wealth gap. They benefit from the forced reallocation of capital into these markets. The detriment is severe for retirees and workers who rely on safe returns from their savings. They find it impossible to earn a meaningful return on their capital without taking on excessive risk. This undermines financial planning and security for a large segment of the population. Looking to the future, central bank digital currencies, or CBDCs, are presented as an evolution of money. Proponents argue they will enhance efficiency and financial inclusion. However, critics warn that CBDCs represent a tool for unprecedented and total financial control. These digital currencies could enable central banks and governments to implement a range of intrusive actions. This includes the ability to freeze funds, block unapproved spending, or even impose negative interest rates directly on individual accounts. Such capabilities would grant immense power over personal finances. The beneficiaries of a CBDC system would be governments and the elite. They would gain ultimate financial surveillance capabilities, monitoring every transaction and potentially influencing behavior. This level of control is unprecedented in modern history. The detriment is a profound loss of individual financial freedom and privacy for everyone else. The ability to transact anonymously or outside the direct purview of the state would be severely curtailed. This represents a fundamental shift in the relationship between citizens and their financial lives. Given the pervasive nature of central bank manipulation, individuals must consider strategies for financial autonomy. Diversifying away from traditional, centrally controlled assets is a critical first step. This involves seeking alternatives that are less susceptible to inflationary pressures and direct government intervention. Investing in decentralized digital assets like Bitcoin offers a hedge against currency devaluation. Its fixed supply and decentralized nature make it immune to the money-printing policies of central banks. It represents a direct challenge to the traditional financial system. Holding physical assets such as gold, land, and essential commodities provides tangible value that cannot be digitally inflated away. These assets have historically served as stores of value during periods of economic uncertainty and currency debasement. They offer a degree of independence from the banking system. Avoiding unnecessary debt is another crucial strategy. Debt ties individuals to the very system that is being manipulated. Reducing financial obligations provides greater flexibility and resilience in an unpredictable economic environment. Finally, supporting and engaging with decentralized finance, or DeFi, offers a path toward a more open and transparent financial system. DeFi platforms operate on blockchain technology, removing intermediaries and offering financial services directly to users. This fosters a more equitable and less controlled financial landscape. The evidence strongly suggests that central banks, despite their stated intentions, manipulate economies in ways that disproportionately benefit a select elite. Their policies of money printing, interest rate manipulation, and bailouts create a system that enriches the few at the expense of the many. The looming threat of central bank digital currencies promises even greater control and surveillance. The current financial system, heavily influenced by these central bank actions, is showing increasing signs of strain. Inflation, asset bubbles, and widening wealth gaps are symptoms of a system that is failing the broader population. However, this challenging environment also presents an opportunity. Alternatives are rising, offering pathways to reclaim financial autonomy. By understanding the mechanisms of manipulation and embracing decentralized sound money principles, individuals can make informed choices. The choice is clear: remain dependent on a system designed for elite benefit, or actively pursue financial freedom and sovereignty.